Mitchell, welcome to the show.
Yes, Owen. G'day.
G'day. What's news?
I've just literally got Clive Palmer on the mind. We were talking about it off air and I just went blank then when you asked me what's news, and so I just said Clive. The reason why Clive Palmer is on the mind is because we just this weekend popped down to the Mornington impromptu getaway, and his billboards are everywhere. Yeah. Absolutely everywhere, and I can't make sense of Trumpet of Patriots. But anyway, let's not let that sidetrack this conversation.
So today we're talking about some lessons learned potentially from some of the worst investments ever. I got some questions around this. You've shared a list and you did a write-up this morning which covered a little bit of it. Worst investment, what would be one straight out of the gate?
Worst investment. My worst investment, I think we need to clarify. Yeah. Worst investments ever. My worst investment, if we're talking on an actual dollar value, it probably would have been Fleetwood, which was back in the day like a mining services company. It supplied temporary accommodation and villages to mine sites. So Sea Ripple was its biggest one in Karratha. I think it still exists today. I've not followed the stock in it for a long time. But essentially this was riding the wave really hard of the mining boom in the mid 2000s. So 2010, 2011 it peaked. And, you know, I came in 2012 when it was looking like it was, some deep value was on offer. So I ended up selling out at $2. So if you can see the chart.
Adrian, can you bring this up for us?
Oh, thank you. It was a wonderful memories to kick off the week. Where did I buy? I think I bought at around $10. So it'd come back from about 14.
In that little blip there, so like 2011, 2012.
Yeah. And no, I think in the next blip, the next one. That one. Yeah.
Ouch.
There we go.
And then it just, I vaguely remember this.
And then I just decided to hang on for a while and, copping about an 80% loss. So
Fleetwood.
So there you go. Fleetwood, they, was really riding off the back of that iron ore boom.
Right.
And they had, occupation was through the roof at all of their villages. Everything was going well. They also owned, if you're familiar with caravanning, they owned a number of caravan brands like Coromel, for example.
Coromel.
And then they also owned, if you ever, owned a ute, and you got the canopies on the back, that plexiglass, they owned that brand as well. But because the mining side of things was booming so much, I think they really underinvested as well in that caravan brand, and their caravans becoming quite old and tired. And so once the air was out of that the mining balloon, and they had to look elsewhere, they found that they were relatively uncompetitive as well in that space because they had underinvested in so long. So my key takeaway from there was that was the last mining services stock I ever bought, I think. And no, it's not. The other one was a good one. But they, I would say they certainly didn't control their own destiny. And I think a lot of ASX investors, a lot of people that you talk to will say that they avoid stocks that cannot, that are a price taker and not a price maker. And by that, these guys were really dependent on the price of iron ore and commodities. And if that turned on them, then, you'd have the likes of BHP, Rio, Fortescue, etc., closing down sites. And all of a sudden, you're closing down sites. Well, no one's going to live there just because it's a nice place to hang around.
The middle of WA.
Yeah, exactly. Yeah, so that was probably my absolute worst.
Okay, I love it. And I just looked up Coromel. They got Soul Seeker. They got 3 different versions of the caravan.
I think they've since sold those, the caravan business.
Soul Seeker, Adventure Seeker, Thrill Seeker.
They're all the same
Jewel.
bloody caravan, aren't they?
They just change the colour.
They do. The Thrill Seeker, of course, is red. Adventure Seeker looks like their eco model in green.
They're actually, I mean, we shouldn't shoot them down too much, but maybe one doesn't have a step. That one's got 2 steps going into the caravan. Anyway,
they are the exact but they're the exact same caravan. I'm sure there's different features, but
anyway, there we go. So for people who are unfamiliar, for people, obviously people would have heard you on the podcast a lot, and hopefully more in the future. What do you do at Rask?
I'm the head of funds management at Rask after we've just talked about what a terrible stock picker I am. So, if you want more of that, come on down. So, head of funds management. Yeah, I oversee the operations of Rask Invest.
Yep.
And so if you've ever come on board Rask Invest or had a chat with us or whatnot, you'd be talking with me. And I can absolutely confirm there are no ASX small caps in our portfolios. We invest in big, broad, diversified ETFs where I cannot do anything. Do that type of thing with investors' money. My own money only was on the table with Fleetwood.
Oh, we've all been there, right? Like Fleetwood. We'll come.
We've got plenty more to cover off.
We've got some more companies to talk about, but I'll share some of mine as well. And we've all been there. I think that's like a rite of passage for a lot of people. If you don't take the risk, then you don't get the reward.
It's your tuition fees.
Yeah, that's a good way to put it.
It's better to make mistakes when you're young.
Yeah.
When you have maybe $2,000 in the stock, rather than when you retire, get bored. I've seen this happen. Retire, get bored, convert your super to an SMSF, and start trying to pick stocks. Yeah. And all of a sudden, you're playing with $1 million portfolio and not a $10,000 portfolio, and the mistakes are impacting a lot bigger, lot more people than just yourself. They're impacting your family. Yeah. And there's no stress like financial stress. So, even though it's all fun and games right now as we're having a chat about it, I've seen people get themselves into overconfidence come into play, and people get themselves really into trouble with that. Yeah, especially the retiree cohort. I find that's really stressful. And a lot of people think that they, because they might dive deep for a year or two and they think they've got it under control. Oh, yeah. It's a big, scary time. And the last thing you want to be doing is learning on the job while you've got your life savings. Because it's not, the way I think about that is, it's not necessarily like percentage returns or dollars in a spreadsheet. It's actually years of lost income. Like you're in retirement, your money's there to provide for you and your family for a set number of years for most people. And so every mistake is a year or 2 or 3 worth of passive income. Now, if you absolutely have to scratch that itch, which I understand, totally. If you absolutely have to, if you love reading about this stuff and exploring it, and it's the way it helps you keep active with your mind as well. I know a lot of retirees do that. They like to invest because it keeps their mind active. For sure. Carve out a small amount. Carve out, go, hey, this 5%, 2% of the portfolio, whatever it is, just carve that out and say, this is what I'm going to do with that, just to satisfy that need. Yep. I like it. So you head up the funds management side. We're recording this April 2025. We've had a lot of volatility recently. Yes. I'm curious, maybe some of the things that you might have learned from our community or just yourself dealing with the community so far in 2025. Well, I just fill everyone in here. Owen did say, let's not date this. When he said to me to come on, he's like, we want this to be evergreen. So we're doing it at 10:23 on the so 2025's been, we peaked in February. Our 1-year numbers for Rask Invest were doing incredibly well. It felt good to be investing. Yeah. There was always that shadow over our shoulders of, something's going to come along, like the market's a little high. Yeah. Something's going to come along and take the steam out of it. And Trump was just getting elected at this time as well. Yes. Yeah. Fast forward, I have seen anyone in funds management or financial advice, when the market takes an absolute hammering, as it has done, your phone starts to ring, emails come in, clients ask questions.
It's spooked, yeah.
Yeah, it's part and parcel of the industry, and you're there to calm nerves and say, hey, this is what we're doing, et cetera, or this is why we've set portfolios up the way we have. I got to say, the Rask community, the Rask Invest investors, I absolutely love working with them. My phone didn't ring once.
That's great.
That's
really good.
It's testament to the years and years and years of education that you've put into the community, that they're all relatively calm, and if anything, the non-calm moments are them clamoring to get more money into the market.
Yeah.
And so that's a fantastic place to be in. And because if we step back and talk about from a funds management perspective as a business, I always have a saying about hard won FUM. FUM is the acronym, funds under management.
Yep. And
I always talk about this hard won FUM being the really good measure of a business. It's money that that comes in when markets are down, when times are tough, because it comes in from investors who I think are long-term minded, and they've got the right attitudes and the right attributes to be great long-term investors. And that's, from a business perspective, that's who I want to be dealing with.
Yeah. You want people that are bought into the actual ethos and the strategy. Yeah, because otherwise you end up with people that just chase performance, right?
Yeah, and that's the absolute worst way to grow wealth. If you're chasing performance, you're literally continuously buying yesterday's heroes.
Yeah.
Which is basically, if you look through all of my stupid individual stock picks, they were yesterday's heroes.
Yeah.
Literally, that's what I was doing.
Absolutely. And there's a lot of confirmation bias that happens when you go for that.
Yeah. So. Last week was a really intense week when we had lots of news coming out every single day, and we were getting whipsawed around. But it was incredibly positive time for our community as well. And I've seen so much dollar cost averaging going on. I would say to people not to worry that they've missed the boat if the market does recover. That's the one thing I don't want to see. Lots of people clamour to get in there, and which is one thing of market timing. People see that as a positive, which it is, but it is also market timing. So you have to move past that bias when things normalise and continue on your plan. That's what I really want to see now. If we are out of the weeds, so to speak, that's what I want to see our investor base do now.
Yeah. That's a good point. I think that I probably didn't help that when I said that I invested in the bottom of the market, but I had the money anyway, so I was going to do it anyway.
She's day trader over here.
Yeah, but it's true, right? And I think you wrote something, which was that investing while the market's down is fine, but waiting for the market to fall is timing the market.
Yeah. Well, it's all timing the market, isn't it? Like if you're holding back in anticipation of something, it's market timing.
Yeah, that's a good point. So we're going to get to more of the mistakes in just a sec, but one final question I want to ask is, what's been the biggest change to the way you think about investing?
Recently, or just in general?
In general.
In general, it would be. I didn't prepare for this one, Owen. So,
since you made those first investments, which we'll come to in a sec, what would you, if someone could just get the elevator little summary or the trailer of what you've been doing?
I've done is invest in what I know. My best. So we're talking about my worst investments here, but maybe we'll do one eventually on my best. But invest in what I know, and secondly, it's diversify. So I have, if you stand back and look at my portfolio now, it's a core and satellite style portfolio. I use a broad diversified ETF as 50% of the portfolio. I then have a range of small cap funds here in Australia, because I made the conscious decision that I want my capital to be going into Australia's next biggest and brightest businesses.
Yep.
So that's something that I want to be contributing to.
Yeah, fair.
And so it's incredibly well diversified portfolio now, and I think much more, 100% more actually, about the portfolio construction than the constituents that make up the portfolio.
Yeah, it's good. I like it. Okay, so you've given us a bunch of different companies that we can just riff on. More like the lessons learned is what we probably want people to take from them.
Yeah.
And what, in anticipation of today's episode, you categorize them for us as young, dumb Mitchell and confident, dumb Mitchell. So
the two are not mutually exclusive. So there's a big overlap in young, dumb and confident, dumb.
So you wrote about this recently. You wrote about 3 stocks that fall into this young, dumb category. But I didn't think the actual investments were that bad for what it's worth.
No, they're not. One's the biggest company in Australia right now.
So give us the story of like how these ended up in your portfolio.
Yeah. So many, many moons ago, I was my first job in the investment industry. I was doing customer service and sales for a stock valuation tool. I don't know if you remember it. It was called StockVal originally when they employed me. I still had a StockVal hat, which I now can't find, but a great bit of merch. People might remember, like, it was Roger Montgomery was the main kind of driving force, the main name behind StockVal.
Okay.
But he wasn't there when I came in. It was owned by Climb Asset Management. So
Got to bring this up, Adrian. So we've got a LinkedIn profile here, which is StockVal
Oh, it's
team.
still there.
Well, it's just a StockVal team. It says on LinkedIn, owner Climb Asset Management.
Yeah. That's it.
Yeah, right. So,
but it's now called. I think it had a couple of iterations. It's now. It went through StockVal, rebranded to MyClimb, then rebranded, I think, to Climb Direct, but I wasn't there in that time. Anyway, long story short, I made a lot of great mates there, some of who I still work with today, a lot of who I still talk to on the regular.
okay.
And there was, I can't remember what it was, what year it would have been, but there was we were doing an end of financial year sale.
Okay. So this is like a membership subscription?
Yeah, it was a membership subscription. They released all their valuations on businesses.
Ah, okay,
yeah,
gotcha.
That's StockVal.
Yep.
That's how it kind of came together. And so it had data and a couple of articles a week, plus you could look up and see the inputs, and you could change the inputs if you wanted to test different assumptions. It's pretty cool.
Huh.
Great learning ground for someone just getting into the business.
Yep.
Anyway, so one end of financial year sale came along, and I crushed it.
Call it like it is.
I did. Young me. I had a breakup from a long-term relationship, and I had nothing else going on. Threw myself into this sale. Holy moly. I made the commission check was enormous. Made the CFO like uncomfortable. And so, yeah, I came away with this very large sum of money for me. And I wanted to do something smart with it. And so I remember going to lunch with the analysts who were all good mates of mine. I was like, boys, what should I do here?
Yep.
And, we're coming out of Greece was still front page news.
Oh, the debt ceiling and all that sort of stuff. Yeah.
That's what, 2011.
Yeah.
It would make sense that they had money to put into Fleetwood. 2011, 2012. And I bought CBA, Brickworks, and BHP. Not bad. Like, if someone says they're my worst investments ever.
Let's bring them up, Adrian. So
2012, it was around $50.
CBA was $50 now, $150. What was Brickworks at the time?
Brickworks probably hasn't changed that much. Oh.
So 11 is now 25.
The dividends that Brickworks would have paid.
And what was the other one?
BHP.
Yeah. This is paid at Mozza in terms of dividends.
It's around $45, was it? No, 30?
Yeah, 30 bucks. Yeah. But it's paid a lot of dividends.
Same with Brickworks and Commonwealth Bank.
Yeah. They're solid companies.
You would have been very, very happy if you bought them and held them. So this is young, dumb me. I did not buy and hold them.
Okay.
I bought them. And then what I didn't have in place was an emergency fund. Literally step one that someone would talk to you about investing is having that emergency fund set up. So you do not have to interrupt your compounding. So what's, Charlie Munger's number one rule of investing, do not interrupt your compounding unnecessarily. And that is why we have emergency funds. It might be boring to wait and save and build those up, but they're so important to give you that confidence to continue to hold. Who knows, I could hold them today if I didn't bugger this up.
Yeah.
And, stupid me didn't just not have the emergency fund. I went and did one of the dumbest things ever. And in lieu of it, I ended up with a credit card.
Right.
And so I eventually had to sell these stocks to help pay down the credit. Yeah. So it was really stupid.
So it's more of a behavioural mistake.
Yeah, more of a behavioural mistake. But it would not have happened if I didn't have that emergency fund set up.
You would have been in your 20s at the time, though, and forgivable.
Yes. But still, I was thinking about it on my way in this morning. How many years did that actually set me back? Quite a few. Probably 4, 5, 6 years.
Wow.
Because just having that debt like lingering over you and whatnot, because you pay a bit off and it just goes like that until I actually properly knocked it over and a weight was lifted off your chest. And I didn't tell anyone about it because, if you're in finance, especially if you're in the industry, there's certainly not a stigma, but you probably feel shame.
Yeah.
A lot of shame about it. Because you're the one that's meant to know better. Yeah. But I was mid-20s, living in Sydney,
you just got this huge, once-off.
Having the time of my life.
Yeah. And you probably thought, I could do this all the time or I'll make it up, next year if I spend more now or whatever. Yeah.
And the last thing I wanted to do was sell these stocks because that was me holding those stocks was affirmation that I was on the right path.
Yeah.
So that's the last thing I wanted to do. So it just, so something that had such positive positive starting point turned into be just a really, really stupid dark time.
Yeah, fair enough. And thanks for sharing that. It is, I must admit, and then you're also, the thing about finance is you're surrounded people with money.
Yes.
Because people, if they're clients, they come to you, they've got money to invest.
Yeah, and this fund manager that I was working at, I mean, you couldn't walk through the door if it wasn't $500,000.
Yeah. Wow. Okay.
So, and everyone you were working with was smart.
Yeah.
Or sounded smart. You had to. If you didn't sound smart, you weren't there.
Yeah.
Yeah.
Yeah. Fair. Yikes. Well, we've all kind of had those moments, but it's interesting because that's a big behavioral thing, and particularly for young men, dare I say, I feel like fall into this trap easier than probably their counterparts do, because there's a sense of this kind of, I'll go out and find a stock.
Well, yeah,
I'll invest my way out of this, or I'll earn more in the future.
It's ego.
Yeah.
It's a lot of ego, whether you know it or don't.
Yeah.
That's there.
Yeah, true. That's actually a really good lesson for a lot of people then, is just that kind of lifestyle adjustment that people make. Is it takes a long time to claw your way out of debt of any kind, family, tax, credit cards, mortgages. It's all the same. But
some's more positive than others.
Well, good debt, bad debt, right? Yeah, absolutely.
Yeah.
But it can be. I can imagine that would have been a pretty scary time in terms of holy shit, what have I just done?
Yeah. And you know what? The credit card came around really kind of innocently. It wasn't, I want to go on a holiday or I want to dig myself out of a hole or something like that. It actually came along from, I was traveling a lot for work. And so I was booking all my flights, all that kind of stuff. And I thought, well, I'll get a Qantas.
Yeah.
Get a Qantas Amex.
Yeah, of course.
And I was getting triple the points in a way. I was, got the gold membership and all that kind of carry on. But then it just creeps up on you, doesn't it?
Yeah.
Like I think like everyone knows if they've found themselves in that situation.
Yeah, for sure. Well, that's young, dumb Mitchell,
Yes.
which thank you for sharing. We've all been there. I've definitely had my fair share, which I've shared before on the show. Here's a quick one for you, just as it comes to me, is do you think of all the mistakes, do you think the profits of investing have outweighed the costs of investing, the losers?
For myself?
Yeah.
100%. Absolutely. So, a stock can only go down 100%, can't it?
Yeah. Yeah. That's the old cliche.
Yeah. But no, absolutely. And I mean, investing just hasn't given me money in life. It's given me a career.
Yeah.
It's given me the majority of my adult friends.
Mm-hmm.
So a lot has come from it.
Yeah, fair enough. So on the other list, there's some interesting names. Maybe we start with, do you want to start with Eroad?
Okay.
What do you want to start with?
Nah, look, you've brought up Eroad. Let's get into it.
Okay.
I think our paths cross on Eroad a little bit.
It may have, yeah. So let's bring this up, Adrian. So Eroad, Kiwi business by origin, I believe. It's IPO'd on the ASX around 2020, went up to, what's this, like 537. That was in 2021, so a year later. And then subsequently imploded and it hit like 40 cents 2 years later. So from 5.50 to 40 cents, and it's around 80 now. So not a good 5 years for Eroad.
Now looking a bit rough there, isn't it?
Yeah. And for people that aren't familiar, it's effectively a tracking business. It's like the old Navman.
It's kind of tracking and road safety for logistics companies. So trucking predominantly. And the big goal, and then it's happening, it was rolling out these systems in the US. Yeah. And basically it was to track, how long a driver had been driving for and fatigue and the truck itself, and report back to base.
Yep.
And which, seems like there's a large addressable market there for a business like that. And safety is something that no company is going to cut as well. So you'd imagine that's a relatively resilient business. A huge part of the investment case as well was built around the CEO at the time. I think his name was Steve Newman, I think. And so this is confident dumb, and this is why I've posted this in the confident dumb section. A lot of my friends are analysts, very good analysts. And one of my friends was talking about this business and talking about how good this CEO was and how much work he had done. This analyst had interviewed him a number of times. He'd contacted and done a lot of interviews with staff members, current staff members and former staff members, people in his local community, everything. And everyone glowed about this man. I think he was one of the heads of one of the big satellite navigation businesses, not TomTom, but it was a different one, a household name.
Yep. And
so people thought if he could do that if he could have similar success with this in such a huge addressable market, it could be an amazing business. I bought in at around $2-ish, I think. And 2 months later, very abruptly, the CEO leaves.
Yep.
And so much of the business case for a lot of investors was built around this man. And people leaving a company, no problems. Founders leaving a company even, okay.
Yep.
Leaving abruptly with little to no explanation.
Yeah.
That's a huge red flag and something that I didn't stomach and said, rightio, well, a huge part of my investment thesis is built around this man, I'm out. And, I sold it 80-ish cents. And so now it's, certainly a bit below that. And so
you took a bit of a haircut, not
stupendous. Yeah. So like that really highlighted to me key man risk.
Yep.
In a business, especially when you're staking so much of your investment case on that. One other stock in here certainly had key man risk associated with it, but I bought it after it gone, so I can't use that as an excuse.
It's definitely a thing, right? The charisma and the kind of strategic vision of a founder is often very important. Even if it's not
a lot of confidence and trust is placed in that.
Yeah, because effectively as investors, we're saying, here you go, Mr. or Mrs. CEO. You take this money that I could probably put in the bank, but I want you to invest it in this wonderful business that you're running because you're going to get me a better return. And as soon as that changes, it changes in a big way. Yeah, I remember this business. And for folks that aren't familiar with the technicalities of this, depending on the geography around the world, Adrian, can we bring this up on screen for people that are watching? They kind of look like that. You were right. Navman was his previous horn.
Yeah, it was Navman, yeah.
Yeah, it kind of looks like a little Navman device that sits on the dashboard. It's got cameras and stuff of the cabin and the driving. But one of the things that happens is actually it allows the trucking companies and the fleet companies to claim things like tax credits and deductions, but also calculate levies because big vehicles like trucks actually wear the road down quicker. In some countries and states around the world, they actually pay a higher level of rego, and it's dependent on the amount of driving that's done. So they're legally required to record where they went, how long it took, these types of things. So it is quite a technical business, but at the end of the day, it's tough when you've got a business that's a founder-led one that's kind of emerging from that. Another business that you mentioned, because you brought in key person risk, which is a business that virtually everyone would be familiar with, is Magellan Financial Group. So let's bring this up again. So we can see here, 5-year chart is, ouch.
Point on the chart where Magellan hurt you.
So this is a funds management business. It was run by a very charismatic CEO who's been on the show.
He's been on the show, yeah.
Yeah, Hamish Douglas. The business was founded by Hamish Douglas and Chris Mackay. Chris kind of took a sideways step and manages the MFF.
Yeah, which is MFF Capital, which that step I think happened roughly around 2013.
Yeah, right. Okay, so he's shifted off. They started the business.
They're two very different characters. Very different personalities.
How would you describe them?
Hamish is very incredibly charismatic. I remember going to a lunch and just up the road at the Sofitel.
Oh, yeah. Here in Melbourne,
Yeah, at the ballroom. And it was me sitting there. I was with Eureka Report at the time. So I was relatively dishevelled compared to everyone else in the room.
Well-nourished.
And it was me and basically an entire room full of advisors.
Yeah, okay.
And I was a hoot of a time. Hamish just walked up and down, like no script, no standing in front of a lectern, lapel mic on, and walked up and down on that stage doing a TED talk like he was Steve Jobs.
Yeah, I figured he'd probably hover across the stage.
It was bloody impressive.
Yeah, he's such a great speaker.
And, every single good investor, great investor I've met, cannot talk in front of anyone. You wouldn't want them sitting in front of a client, let alone a room full of people.
Yeah.
And so he was just captivating.
Yeah.
And you can see how it came to be. I think at the peak it had about 120 billion of funds under management.
Yep.
That's a lot of fees.
Yeah, and they also had, which we'll talk about, they had Guzman, GYG, the Mexican chain, which is now Baron Joey still got that, I think.
Yeah, they still got a chunk of that.
Which is a huge investment bank now. It was profitable a few years ago, I think.
FinClear, which is the back end broker that we use at Rask Invest.
Yeah. So they kind of morphed in from just a simple global investment strategy and an infrastructure strategy run by Gerald Stack into a well, we can invest in public shares for you. We can also use our company to invest in private businesses and seed private businesses.
And that was the future opportunity as well. I think people at the time were starting to talk about them as a mini Macquarie.
Yeah.
That term was getting thrown around a lot. And you could see how it made sense. They had this stability of the funds management business, the cash flow, serious cash, pumping off $120 billion of funds under management.
Yeah, great business when you got that.
Yeah, and that could then fuel the runway for the next leg of growth, which would come from these private businesses and more of a private banking kind of side of things. Now, I did not invest at that point in time. I invested at the exit of just after the exit of Hamish Douglas. So if you remember, 2022. They lost a big client in the UK.
Yeah, that big pension fund.
Yes, and rumours were starting to kind of swirl. And then all of a sudden, Hamish is on leave. He's on extended leave. Next minute, Hamish ain't coming back.
Yeah. Could bring this up, Adrian. So this was like 2022. And this
so there was a couple of big down legs. I invested, I think, after that first, at about
that's when
high
you left,
20s.
March 2022. Or was that when
he was already out the door by then.
Okay. So it fell, for people that are listening, it fell from in 2020, late 2020, it was like $53 a share.
Yeah.
It basically, by the same time, a year later, it was 31, and then following year, 11.
Yeah.
So it's just boom, boom, boom. And it's basically, it's at $7 now.
Yeah, and it hasn't recovered since.
What was also interesting, because we looked at this just before we started recording, was that it had some really impressive businesses. Like the actual vision of, because the thing about funds management businesses, easy come, easy go, which we talked about at the very start, is you invest with Magellan, then you can just redeem and get out, right?
Mm-hmm.
But then they moved into like closed-end funds. They moved into private markets. They had a lot of incentives for people to switch from different trust structures, so that it basically meant that even though it was like they could almost see that this maybe was too good to be true, let's do something else and keep some of the money in these structures where people can still sell their investment, but we maintain this management right, if that makes sense.
Yeah, that makes sense. But so what I've since learnt, you want to own a fund manager when they're raising fund.
Yeah. When everyone wants to invest.
When they've got that momentum behind them. Because we've seen likes of Platinum, for example. It's a business that matured and it's gone sideways for a very long time.
Yeah.
Magellan, had matured. And then, though, when it lost its key frontman and just you saw mandate after mandate after mandate, I was reading an article on the way in here today, and they're still talking about, we're seeing outflows slowing down. 2022, went back to the annual report. 2023, that annual report. The next one, year after year, they're still talking about outflows slowing down. When are the outflows actually going to stop?
Yeah.
That's a problem. But new CEO in now, and I'd absolutely love to get her on the Investors podcast and just talk to her. But turnarounds rarely actually turn around.
Yep.
Or if they do, they take a very, very long time to turn around. And so we know that being early is often the same as being wrong.
Yeah. Yeah.
And so I didn't realize how baked in, say, Hamish was to the biz. Like, you didn't have any other rock star kind of investors, analysts to step up and fill those shoes. In fact, you saw Chris Mackay come back for a brief stint to calm nerves. You've seen Nikki Thomas come back for a brief, to do the same. But we're seeing now Gerald Stack leaving.
Head of infrastructure.
The infrastructure, one of the major funds.
Yep.
We recently saw a couple of analysts leave and set up their own fund under the name of Canopy. And they've set up under the Bennelong stable. So, yeah, I think a very, very long way to go still for this business.
It's interesting because if we look at performance, say, of the Magellan Global Fund here.
Since inception's okay. I think the since inception numbers are still fine.
Yeah, they look pretty good. 14% over 3 years, which is pretty good. Benchmark's done about the same, so it's broken even there. It's that 5-year window, which is still a bit harsh for it. But they've got that many different vehicles and good businesses inside.
They've got fantastic distribution channels.
Yeah, their sales team, their marketing's good.
And do we see them as well now open up and we have seen them bring on another fund into the stable, and they've got Airlie as well. So it's almost that pinnacle style model where these fund managers can lean on the distribution, marketing, and administrative powers that they've got, and allow those analyst teams to do their own thing under their own brand.
Yeah. So key person risk, is that the kind of lesson learned from Magellan? Or just invest on the way up?
I think it's what
because I do phrase some businesses, to be honest with you. I say it tongue in cheek, but it's actually legit, is be there for a good time, not a long time.
Yeah.
With some businesses. You just have to be aware that there's like competitive forces that this business can be great for a limited window, and funds management businesses are often one of those because easy come, easy go.
I would say that the lesson here, and the lesson with a lot of my mistakes, has been because I've come to investing, and every job I've had in the active side of things has been value-based.
Yep.
And a lot of these guys get excited about deep value. And a lot of them get excited about complicated businesses where a lot has to go right. If you think about your best investments, you can take the business case in one sentence.
Yeah.
And it's simple and it's obvious for everyone to see. But here I was fishing around the bottom of the barrel, looking at a filter of 52-week loss.
Top dividend yield. Yeah, those ones.
Get out, I wouldn't do that. Come on.
But people do those, right? That's the equivalent. It's what's the highest yield? Lowest PE ratio.
Give me a 10% yield and no risk. So, I think fishing around, I don't think fishing around in the 52-week lows kind of filter, that's like stock prices that have hit their lowest point in the last 12 months. It's not a place where novices should be hanging out. And even though I've been, back, I would certainly put myself in the novice camp in that category of picking individual stocks.
That's a good lesson.
Yeah, and I think if a lot of people like to quote Warren Buffett, or there's a Warren Buffett quote for pretty much anything. But for this situation as well, I think a lot of people focus on the what-if scenarios, the total addressable markets, turnarounds, all this kind of stuff. But what Warren says, the number one rule, his number one rule to investing is don't lose money.
Yep.
His number two rule is don't forget about rule number one. Right. And I don't think a lot of people just think about it from a risk perspective when they're picking individual stocks coming to the market, looking at small caps and looking at these, potential gains.
Yeah.
You have to focus on that risk first. And if you don't have a risk framework yourself, there's some good ones out there. Like if you're a podcast listener, and I know someone that you follow really closely, you love David Gardner from The Motley Fool.
Oh, yeah.
Over in the US. He does his podcast, the Rule Breaker Investor podcast. And he did a 3-part or 4-part series, and he broke down his own 25.
Yeah, the risk
matrix.
Yeah.
Fantastic series. If you Google it, if you are an individual stock picker yourself.
But you know what? He talks about stuff that's like people in the finance community think it's like, oh, he's just airy-fairy, fluffy kind of ideas. Yeah. And people are like, that's so stupid. That's not science. And he's like, well, probably got the best track record in the world. So thanks.
Well, he wouldn't be caught dead looking at 52-week lows.
No.
He's always about what company is hitting its 52-week highs.
Yeah.
Show me a company doing good, because good companies can continue to do well. It is incredibly hard to turn around a bad culture or turn a business around. If anyone's ever worked in a business where it's started going pear-shaped, it's not turning around in a month.
No, that's right. All right, we've got time for this last one, which we don't have to go into too much depth, but Mitch, the last company on our list
here we go.
Is a company called Retail Food Group. RFG is the ticker symbol. Let's bring this up. This is probably saving the best for last. I don't know what you would call this on a chart, but if you ever look at the Retail Food Group share price, it kind of looks like if you're at the air show and a plane was going up to do a performance over like 10 years.
Like what we radio.
And then all of a sudden the engine stalls, the thing just goes straight into free fall, and at the very last second the pilot pulls up and it skids across the ground for another 6 years.
I would like people to know who are watching this. I think I was not there for that rise or that fall, but I was there in 2021. I didn't lose too much money on this stock, by the way.
I was there for a bit of the rise and didn't enjoy the pleasure of that descent, to put it mildly. Like I did okay out of it, but at the time it was a dividend darling.
Yeah. When I got into it, it was after they had the Royal Commission into the franchisees. It was after these guys had been slapped with a massive fine, and it was a turnaround play. And once again, turnarounds never turn.
Yep.
It was complicated. I didn't believe. In the end of the day, I sold it because I'm like, just had to sit back and go, do you actually believe in these businesses? Like, do you want to,
Gloria Jeans, Crust Pizza. They were the good ones.
They were the good ones. Donut King.
Yeah.
Mate, when I was 10, I remember Mum and I would go shopping, grocery shopping, and I'd get the 2 free cinnamon donuts when she bought a cappuccino.
Quote unquote cappuccino.
It was... Being regional, they love to call them, they love to also give you a muggerchino. So, yeah, I had a realization at that point going, what are you doing?
Yeah.
Just stick to what you know. And look, maybe one day we'll do an episode on my best investments, but this is not the time. But it was just an eye-opener going, look, I didn't lose too much money on it.
Okay.
I think I bought at 9 cents and sold at 7 or something like that. And I was like, this is just dumb. It was just dumb. You're hoping for a turnaround. I think it was my little thesis was it's just post-COVID, like everything was opening back up. People weren't coming back into the city.
No.
People were staying regionally. People were staying in the outer suburban kind of shopping centres and things like that. They weren't coming into the city. And so I thought, they had things like Brumby's, Michelle's Patisserie, Crust Pizza, the donuts.
Yeah, Donut
King.
And they had a bunch of those kind of fringe type.
Yeah. And so outlets. I was like, these are high street. Kind of like Brumby's, you walk along in your high street, or you go to your shopping centre and it's there. Yeah. And I thought a lot of people are going to be staying in those local areas, and we might see a bit of a boom, like a bit of a good time with a lot of the rubbish behind the business now, and we might see an increase. And you didn't need much to go right. It just had to stop going wrong.
Yeah.
Yeah.
That's fair enough. So another complex business, it wasn't until a few of the big private equity players and private credit players like Solpat stepped in and things really shored up. Just looking back over this list, Mitch, I think that there's some really interesting businesses in there. It's fascinating that you started with probably the simplest and best businesses. You increase the little bit of complexity. We'll come back to your winners in another episode for sure. And I don't think necessarily that the decision-making looks like it was horrible. It was just, they were just some of the businesses that are that rite of passage, as you said. It's kind of like the tuition. Like Magellan at the time was a good business. And many people thought it could withhold without the key person because it's got systems, it had other people. Eroad, good technology business. You take risks when you invest in technology businesses. Retail Food Group was diversified. If you're ever going to go into that fast kind of dining experience, you probably want a diversified position to do it. So it's not like
and they clean ship. They, you know, if you ever want to laugh, go and watch the parliamentary inquiries and old mate just saying privilege before every single sentence.
So worried about the downside for his career. The other thing that you brought up off air, which I'll quickly mention, was that Gloria Jeans is one of the crown jewels of Retail Food Group. And they basically, it was like a business in a box. You go start up a Gloria Jeans, you pay the mothership fees ridiculously, hand over fist. And you brought up something that was found, which was something about coffee beans.
Yeah.
So you'd have to, if you owned a Retail Food Group, Gloria Jeans, owned, quote unquote, you would be paying more for your beans than you could get at Woolies, which is crazy.
Yeah. They were just gouging people left, right, and gouging their franchisees left, right, and centre.
Yep.
That was the business model, to gouge their franchisees.
Yeah, it wasn't the customers. It was the people who started these businesses.
Yeah, and I remember reading stories of the franchisees were able to walk down the street to a supermarket and buy their beans and things that they needed to run their business for cheaper than what they could get them off them internally.
So we'll do a couple more of these episodes because it's so much fun, mate. Maybe not the losers, maybe we'll do winners
just
next time.
reliving past traumas. It's a bloody hoot.
If people want to get in contact with you, we'll put links in the show notes.
Because why wouldn't they after this show?
Yeah.
No, but
Rask Invest. But you're also writing. You're in the community every day.
I'm in the community every day. Owen has challenged me to write a blog every single day, which is
fun.
Happening. It's fun. It's it's wild getting up at 5 a.m. every morning to write it. But no, it is fun. I'm very active on LinkedIn, and I've got to stress that, these are individual stocks, these are small caps that haunt my past and have probably shaped and have definitely shaped how I invest now. We invest in broad, diversified, low-cost ETFs for people. We put together these portfolios with risk as the absolute key front of mind component to building these portfolios. We do not gamble with investors' money.
No way.
And we don't take that trust lightly either. So even though we have a lot of fun with this episode, certainly I certainly don't take that trust that we get from our community and from our investors lightly. So
not at all. And we have hundreds of investors that have trusted us in the early days, and they can see that. And particularly, you mentioned the volatility that we had recently. We were on full display. Our portfolios lived through it, and a lot of the community invested more. And that was probably the scariest thing that a lot of our investors had been through up until that point. So they could see not only that the portfolios came through the other side, but secondly, that we were there for them. Which is more than can be said for a lot of the other organizations that operate in this space. So,
yeah, and I think that's a good call to action for anyone who's listening and isn't in the community. The community's free, and the community's so good. Like I put out a post. It's not just insights from like me and Owen. I put out a post when it all kicked off, and it was just, how are you feeling? That was literally, how are you feeling? I think it's had about 30 or so replies.
Yeah.
And it's just other people showing other people what they're doing. Yeah. So it's like, oh, there's someone else like me out there. Or it's you've got a 20-year-old talking to a retiree. Yeah. And that's really cool. So
check it out.
Yeah. Jump in. It's free. And download the app, the Circle app as well. That's the community runs on.
Cool. Mitch, absolute pleasure. Thanks for joining me.
Cheers, Owen.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.